Hey everyone, today on the final bar, I'm talking to Carolyn Boroden. We'll talk about some key price levels using her Fibonacci approach with the major averages, the S&P and the NASDAQ. Speaking of the S&P, sort of this open, lower, close, higher sort of trend, right? Sort of trudging higher, making up ground through the course of the trading day. But at the end of the day, S&P down just a little bit. We continue to be in that choppy sideways movement. Which move is next? A recovery to the upside, a next leg down to the downside, ladies and gentlemen. This is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. It's Thursday, July 14th. We so appreciate you joining us here on our show today. We're going to talk about the overall market environment, sort of a choppy sideways movement, right? At the end of the day, how much ground has the S&P made up on the upside or the downside? Kind of neither, right? We're sort of in that painful third direction of sideways. And arguably the S&P and the NASDAQ have been in that mode for quite some time here, right? If you look over the last month, we really haven't gained any ground either way. Sort of that it had that sell-off into June, and then we've sort of been chopping around, biding our time, waiting to see which way the market breaks. Now, there are a lot of great things you can look at to try to figure out where things are headed next. Breadth measures, by a lot of the ways that I would analyze them, seem to keep pointing to lower movement, right? If you look at the breadth conditions, cumulative advanced decline lines, bullish percent indexes, stocks above moving averages, they're all sort of still in bear market territory, not really speaking much of a recovery here. Day like today, though, you have technology at the top of the list. And I would argue one of the things to look for is a recovery in growth stocks. We talked yesterday on the show, our guest Sam Burns was talking about the recovery in growth and looking at things like technology for a leading indicator or some sign of life. We're seeing a nice move today on technology. Is it enough to switch that trend from downtrend to uptrend? I'm not so sure. We'll see what today's guest, Carolyn Boroden, has to say about it. We have great guests on the show, by the way. Super thankful of all the great people we can bring through to have some good discussions about the market environment. Just to let you know about the schedule coming up next week. On Tuesday, the 19th, we have Jay Soloff joining us on the show. Jay's an options expert, always interested to hear what sort of plays he's looking to make. On Wednesday, the 20th, Todd Sohn joining us from Strategas in New York. And then coming up the week after on Tuesday, the 26th, Bob Lang coming back on the show. All of our previous discussions, by the way, are all at StockChartsTV.com. Let's continue on today's show. Let's talk about this market environment, recap what we're seeing using the power of technical analysis, and let's get to the charts. The S&P, as I mentioned, down about 1/3%, opened a lot lower. It's down around 37.20 in the first hour of trading, sort of spent most of the day trudging onward and ever upward, getting higher. There's one of my the kids used to watch the Backyardigans, and they had this episode, Trudge, where they were trying to get up this hill. And this is what today's trading sort of reminded me of, just slowly trudging up there, not quite getting to the peak, but trying to get there. The NASDAQ, by the way, up about 1/3% using the NASDAQ 100. The NASDAQ composite was essentially flat, and the VIX down a bit, still just above 26. Looking at other asset classes here very quickly, bonds coming off a bit with interest rates moving higher. The 10-year yield settling in right below 3%, tipped just above it earlier today, same as we saw with yesterday. So overall, you're seeing bond prices come off of it. The dollar index continues to push higher. On social media earlier today or yesterday, someone had called the dollar index the wrecking ball for the markets. It certainly seems to be the case. Just continue to push higher. And what happens when you see the dollar moving higher, it tends to be difficult for certain commodities, particularly like gold, to mount any sort of uptrend. And if you look at the chart of gold, pretty underwhelming, right? Where you're looking at the GLD at the moment, but look at the gold spot index or anything like that. And you're seeing overall just a lack of upside follow through on any opportunity. The GLD down about 1.4%, silver down about 4%, crude oil prices down as well. Most commodities down through the course of the day here. In crypto land, you're seeing some renewed strength to the upside, but still a lot of ground to be made up, I think, before those charts can look anything constructive. At this point, it's more sort of choppy sideways. With Bitcoin, it's important to note that we're back above 20,000. And I found with cryptocurrencies, with Bitcoin in particular, big round numbers have tended to be pretty significant. So we've been chopping around this 20,000 level here for a number of weeks. Can we get above there and stay above there? That's what I'd be thinking on the chart of Bitcoin. I want to just look briefly at the daily chart of the S&P 500 just to see where we're at. And my guest today, Carolyn Boroden, is going to talk a little bit about the S&P and the NASDAQ as well, if we can get to it. So I don't want to take too much away from what we're going to talk there, but just to lay out some of the facts here. We had this sell-off in early June to the S&P around 3650. We then rallied up to around 3950. From there, we have this sort of consolidation pattern. We'll call it a pennant pattern or something like that. Lower highs, higher lows. Now, arguably, we're starting to break that pattern to the downside, right? What's interesting is you sort of have competing evidence, if I would phrase it that way. We've broken below a trend line using the recent lows from mid-June and from late June. We've not broken above, but the last 2 days, where we've actually violated that trend line to the downside, we've been closing above the open. So you're seeing some intraday demand. You're seeing buyers come in after the open and that sort of initial sell-off and sort of pushing prices higher through the course of the day. So it's not like you're getting this big puke out down move through significant support. It's more representing that during the trading day, you have buyers, some demand increasing, and you're seeing prices close more the upper half of the day. So we'll see what's next. But overall, what's the underlying trend? We have the price below 2 downward sloping moving averages. That's a chart in a downtrend until proven otherwise. We'll see what sort of key levels we need to pay attention to as we continue our discussion through the course of the show today. Looking at sector movements here very quickly, as I mentioned, technology is sort of an upside outlier today with the XLK up just under 1%. After that, pretty defensive stuff like staples and utilities, both sort of flat for the day. On the downside, financials, energy, materials, the outliers to the downside. We're going to do a segment a little later in today's show called The Bottom Line, where we're going to focus on earnings releases. We're basically starting to get into the meat of earnings season here over the next couple of weeks. A lot of companies reporting that as the opportunity or a potential to be a significant catalyst on any particular trading day. We'll look at some of those in a little more detail later in today's show. We'll look at some of the banks that have been reporting. So I don't want to get too much into those now. We'll save that for the bottom line segment a little later. I did want to talk about Qualcomm. Technology, as I mentioned, the number one sector. Qualcomm's actually up almost 5% today. It's an interesting chart. And when I'm looking at technology, I'm drawn to charts like Qualcomm, charts like Apple. There are plenty of charts just going down and to the right. And I scan for my own premium members, stocks making new swing highs and new swing lows. This morning, I think I counted 12 stocks making a new 3-month high and almost 400 making a new 3-month low. So it's certainly very much skewed to the downside. And there are a lot of names in the technology sector that fit that criteria. And it's a lot of the emerging growth names, right, that you would probably expect, which makes a chart like Qualcomm kind of an outlier. If you look at Qualcomm relative to the S&P, starting to make some headway, right, and actually starting to break out, right? It's making a new 3-month relative high. That's encouraging. The RSI is getting above 60, which means the momentum is starting to improve. It's encouraging as well. The trend is starting to improve by the fact that it's no longer making a new low, but it's starting to make a new swing high. We're back above the 50-day moving average. Today's kind of pushing you back above that. So what would you look for in a chart like this? So this sort of chart, you're not making new lows. That's good. So let's start to make new swing highs. On this sort of chart, 145, pretty significant because that's where we stalled out in late April, early May. That's kind of where we stalled out in early June. So when I'm looking at a chart like this, I'm sort of keying in on a level of resistance that has been tested and validated a number of times. We get back to that level and we're able to eclipse that to the upside. That's where things start to look even more constructive. Here, it's sort of a trend that is no longer down. It's sort of in what I would call a consolidation phase, right? No longer making new lows, but not quite making a new high. That's what you might want to look for. I mentioned the chart of Apple. I think you can see how that's sort of in a similar kind of pattern on Apple. The levels maybe were 150. That was a level that we tested as resistance in May, particularly early June. We've now rotated back above the 50-day moving average. Can we get above that most recent swing high? So some of these technology stocks starting to improve a little bit. Again, I think there's a lot to be proven before these feel like really great charts, but you're starting to see some upside in some of those names, which again, that's how an uptrend starts to materialize. It sort of shows up on the short-term improvement before it is reflected on the long-term charts. Costco's another one. So what types of names are working in this environment? It's not much, to be honest with you, but the areas where you are seeing some positive rotations, it's things like limited on a very limited basis technology, but it's more things like consumer staples, things like healthcare, which we've been talking about for a bit of time, maybe some utilities, which are showing some improvement in relative strength. Costco comes to mind. It's actually attempting to regain the 200-day moving average. Today sort of closed right at that level, up 4%. So you're seeing some of the big box retailers, not all of them. So something like a Home Depot is still pretty bad, but Costco actually improving. Now, again, the question is, at what point does this improve to the point where you might want to nibble a bit and take an upside position if you're a longer-term investor? We're kind of really close to that, right? We've regained the previous swing high. We've regained the 50-day moving average. We're right at the 200-day moving average. The RSI is starting to get more into a much more positive territory. The relative strength is threatening a new 3-month, even further than that relative high. That's all super encouraging. So the question is, can we regain those? The concern I would have with any of these charts is, what is your stop loss, right? Where are you managing risk if the market sort of goes into this next big down leg? If stocks like Apple would fail to materialize any further uptrend, they start to rotate lower. Keep a wary eye on those previous swing lows and make sure you're managing your risk and managing your capital effectively. Let's take a quick commercial break. We'll be back with today's guest, Carolyn Boroden. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close as we break down the action in these markets using the toolkit of the technical analyst: price, trend, momentum, breadth, sentiment, all of that great information to make sense of these markets in uncertain times. A couple quick announcements before we get to today's guest, Carolyn Boroden. First off, we welcome your questions. It's one of the great parts of the show, being able to have a mailbag segment where we can feature questions we're getting from all of you. Email is the best way to get your questions in front of us. The Final Bar at StockCharts.com. We're also on Twitter at Final Bar SCTV. We're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air in our next mailbag segment, Friday of this week. Also, go to StockChartsTV.com. That is our on-demand platform. There's so much great content every trading day. Fantastic expert commentary from people like Carolyn Boroden, Larry Williams, Martin Pring, many, many others, special events like The Pitch, also ChartCon, which is an event we have coming up later this year. That is a brief teaser for a really cool event we'll be talking about a lot more in the coming weeks and months. All for free at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, Carolyn Boroden. Karen's the owner of Synchronicity Market Timing, coming to us from Las Vegas. Carolyn, it's great to see you and welcome back to the show.
Well, thanks for having me.
So I wanted to bring up your charts. We've talked about the major, sort of market averages, sort of opening lower, rallying a little bit during the course of the day here. Take a step back for us. What's the big picture of the S&P from your perspective?
Well, I mean, as far as this weekly chart's concerned, you can see that we still have a very clear pattern of lower lows and lower highs from the high that was made in January. Also, the other thing that you may see on this chart, these red lines are basically what I call symmetry projections. So what I do is I project the prior rally swings or corrective rallies in this case. I project them from whatever the new low is, and that offers resistance. And note that on this chart, you have not been able to clear that resistance, okay? So if you're looking at this general pattern, typically, most of the technicians are going to look for a new low or an extension to the downside of the most recent low to high swing. But there is something else that we need to look at.
It's very interesting to see that lack of follow through on some of those upside bounces. Your daily chart of the S&P is next, Carolyn.
Yes. Okay. So like, as far as I'm concerned, if you're looking at a chart that has a pattern of lower lows and lower highs, And you also have price below the 200 simple moving average and the 50 simple moving average. And also I like to use a 513 EMA combo. If the 5 is below the 13, that's considered bearish. So in this case, technically it's still showing up as bearish and still telling us that we're still vulnerable to the downside. However, we have a decision right here, right now that could change things. And these are going to be important parameters to watch. Now, I'm looking at this as like a two-step pattern. What I've done is I've taken prior high to low swings and then projected them from other highs. You'll see those red lines there near the top of that cluster zone. I also ran a retracement. You'll see the blue line, the low to the high. Basically, the 786 retracement is just a little bit below those projections. And then the green line, I took a prior low to high swing and ran the 1272 extension. And you can see that that's basically what we tested this morning. Now, this is not a perfect hit, but 3717 was the top end of the zone. The actual low, it looks like, was made at 3721. And this is the thing, even though the path of least resistance would suggest the possible target number 1 at 3552, if this support holds, that can blow that out of the water. So I'm looking at this as a key decision due to price and also pattern, because it's a little bit of a two-step zigzag pattern. And then if we can hold above this current support, or the low that we made today, then we have to start looking for higher prices instead, and the shorts could get squeezed. All the shorts that are looking for new lows.
Wow, higher prices! What an amazing opportunity that might be.
Well,
if we start to see it, right?
Yeah, as long as we can stay above that zone. But then here's the other thing that came together with this. These are what I call Fibonacci time cycles, and what I'm doing is I'm actually measuring prior highs to highs and lows to lows and other combinations here. And what I do is I run the same ratios that I use on the price axis on the time axis. And when you start to see a cluster of timing cycles that come together, what you do is you look for a reversal of whatever the market's doing into that time window. So we see cycles between the 14th, 15th. We've got 1, 2, 3, 5 of them. And the market is going straight down into them. So now you also have timing besides that price support that tells you that you have to be prepared for a possible reversal back up. Now, if we break back down below that support, then yes, you can look at those 1272 targets on the downside next. But right now we're holding above it. And that's something that, we have to respect.
This is super, super helpful. Your final chart, Carolyn, is the NASDAQ 100. How does this relate?
Okay. Well, as far as the NASDAQ's concerned, I had, pretty much the same cycles, the 14th, 15th for a possible low, and we were trading straight down into it. Now, this is not a two-step pattern, but it is a Fibonacci price cluster. So the price cluster is the coincidence of at least 3 Fibonacci price relationships within a relatively tight range. And the first one we have tested and held this morning at 114.65 to 115.06. There's a 786 retracement in there. There's a 618 retracement in there. And there's a 100% projection of one of the prior high to low swings. So that defines our risk. If we continue to hold above there, because there have been buy signals, then the potential would be for an extension to the upside instead. And that would give us potentially 123.67. So it's kind of like decision points. If you hold above it, then, we can look for higher prices. But if you start breaking down below those same key decisions, then we have to revert back to the bearish scenario.
We only have about 30 seconds here, Carolyn, but it's interesting as you're talking about all these key levels and how the market is truly at a decision point. We also happen to be entering a very busy period with earnings season, Fed meetings, and all of that. How do you, as an analyst focusing on the Fibonacci levels and support resistance, how do you navigate sort of crazy busy times like earnings in the Fed? Is this a time to be paying more attention to these levels? How do you sort of reconcile all those competing narratives?
Yeah, one of the things I always tell my traders is that it becomes an absolute crapshoot. My work might work and it might not. And so I tell them typically to wait for after when we have a very clear setup.
That's a great take, Carolyn. Listen, it's a pleasure to see you. Thanks so much for sharing some wisdom with us. Stay safe and stay cool there in Las Vegas. We'll talk to you again soon.
Thanks.
That's Carolyn Boroden. Carolyn's the owner of Synchronicity Market Timing, coming to us from Las Vegas. What a great wealth of expertise. I feel like we got just some brief nuggets of a really thorough and thoughtful approach to support and resistance. What I love about Carolyn's work is she talked about her firm is called Synchronicity Market Timing. You think about what I would call clusters of support and resistance. That's a common technique to look at a number of different timeframes, different levels, different highs and lows, and look where you see a lot of agreement, right? A number of indicators sort of honing in on a particular cycle time or a particular price level and assuming that there's more value to those. That is a tried and true technique. And I think Carolyn did a really good job of illustrating where the market is at some pretty pivotal points. Again, we're entering into the meat of earnings season here in the next couple of weeks. We have the Fed meeting coming up in the next couple of weeks as well. There are a lot of potential catalysts that can really move the markets very, very quickly. Some great levels to pay attention to. Great take there from Carolyn Boroden. Let's continue on this show with our next segment, the bottom line. What we like to do during earnings season, and we start that today, is focusing on some of the names that have reported this week, some of the names that are coming up through the remainder of this week, what key levels to pay attention to, what the market is doing going into those earnings releases, what it's also doing coming out of that, because I think you can learn a lot from those different data points. We'll start in the consumer staples sector. Pepsico actually reported Tuesday of this week, if I remember right. And obviously a fairly defensive name. PepsiCo is what you might call one of the big uglies, right? Sort of pretty defensive, pretty conservative, sort of a blue chip name, kind of a slow and steady gainer, not a very offensive pick, but tends to be more of a defensive play because it's relatively higher in yield and also relatively stable. And as you can see, the relative strength on Pepsi over the last 6 to 12 months has been pretty impressive, right? Consumer staples as a sector has had some nice bright spots, and names like Coors comes to mind, ticker TAP. And Pepsi might be in that bucket as well. Beverages in general and soft drinks have done pretty well, not because they've had incredible price gains. So on an absolute basis, you're not gaining a lot from owning Pepsi. The real value is you're not losing anything, right? You have a relatively stable price profile. So while the market is getting absolutely crushed in 2022, energy has been ripping to the upside up until about 4 to 6 weeks ago. Pepsi's been kind of a slow and steady price action. So you're not gaining a lot on an absolute basis, but in this sort of environment, as an equity investor, owning something that's not going down is a great way to sort of ride out this sort of uncertainty. You also get the dividend component as well. So Pepsi around earnings, not great, not sort of any sort of upside follow through. Actually had a bearish engulfing pattern a couple of days ago, and I'll show you this chart. Maybe make it a little easier to see. It's not a perfect bearish engulfing pattern. It's where you'd really want an up day followed by a down day, but you can certainly see day two, big distribution day, opening higher, closing lower. From there, we've sort of stabilized. So sort of not a lot of action around earnings from a longer term perspective, sort of settling in. I think the story on the chart of Pepsi, as I mentioned, is the strong relative strength. If you want to hang in this sort of environment, own stocks where the relative strength is improving, and overall, you're going to do pretty well. One chart where the relative strength is definitely not improving is with airlines. You had Delta Airlines reporting on Wednesday, and overall, the airline charts are pretty challenged, right? If you think of that whole travel and tourism trade, things like hotels, sites like Expedia, and airlines like Delta and others, not great charts overall. The cruise lines have certainly seen their share of distribution here recently. Airlines at times have shown little bright spots, little signs of life. And even on particular days, they've appeared on some of the biggest gainers on a one-day period. But it's a great reminder to not pay too much attention to the day-to-day movements, right? What stock is gaining just today? Look at the trends. Think about the overall trajectory. When I'm looking at the chart of Delta Airlines, I'm seeing a chart in a clear distribution phase. This is a stock below 2 downward sloping moving averages. The RSI has been below 50 for the last month. Plus maybe the last 6 weeks, the relative strength is sort of declining. So overall, this is an area of the market that's been struggling quite some bit. What would be encouraging on a chart like Delta Airlines is putting in higher lows, putting in higher highs. It's not really been able to do that. Had some bounces recently that have fizzled out very quickly. Most recently, you had the move up to 31. This was on Tuesday, the day going into the earnings release. From there, we've come off of it. So just like the market, you're seeing closes above the open the last couple of days, but not really enough meaningful appreciation, right? And again, it's a great reminder to take a step back, look at the change in trend. And I think we're not really necessarily seeing that here. We now switch to the financial sector. If you're looking for stocks making new swing lows, You've got lots of things to look for in the financial sector, banks, regional banks in particular, even some insurance companies sort of rotating lower and making new swing lows this week. JPMorgan, Morgan Stanley not having a great day, down about 3.5% in the case of JPMorgan. Now, this is a stock that pays a pretty handsome dividend, so a decent dividend yield, but unfortunately, the dividend yield has been looking more and more attractive because the price has come off so much. We've been such a downtrend. So you have to remember that when some of these dividend yields look more and more attractive, you have to remember you've basically had a huge capital loss on your initial investment. You're gaining a dividend, but you're not really making that up in terms of the overall trend in the price. These stocks are making new relative lows. So JPMorgan making a new, or very close to making a new 12-month relative low today. That's JPM. Morgan Stanley's this one. Not quite as bad. And what I mean by that is it's not making a new 52-week low, but not a very exciting chart to be sure. What's interesting about the chart of Morgan Stanley, though, it reminds me of the chart of like Microsoft or even like a Netflix or something, right? What's interesting about a lot of these charts, they're not going up, but they're no longer going down. And that's how I would describe the chart of Netflix. You have the distribution phase, which potentially has at least paused here in May, June, and now into July. It's not making new lows, but it's not making new highs either. It's literally in an equilibrium. That's the chart of Netflix. Compare that to the chart of Morgan Stanley. You can see what I'm talking about here. We're sort of pounded down to around 72.50. From there, we're sort of in wait and see mode. We're sort of in sideways mode. The challenge with this chart is we're very close from breaking down. We get below 72.50. That's now a new low, and it's just continuing this pattern. So what would be my guess as to the next direction? I would assume that the trend stays in place, sort of an object in motion remains in motion. That's the inertia law. And so basically, I would bet on market inertia continues to push a chart like Morgan Stanley lower. However, a new low below 72.50 is what completes that trigger. Just to finish off very briefly, you have a Friday of United, Healthcare, UNH, then a bunch of other financials, Citigroup, Wells Fargo, Progressive, which has been a chart we've talked about so much, State Street, BNY, US Bank, all of those coming up tomorrow. So a lot to look at with earnings and the financial sector. We are out of time for this show, though. We need to wrap it up. Go to the 3 and 3 charts that tell the story of this market in 3 minutes. Let's get to it. Chart number one, the energy sector. We didn't talk about a lot of energy charts so far today, but energy has been the story of 2022 in a lot of ways in terms of, what an incredible upside outlier for still year to date. I mean, the best performing sector, and it's not even close, but really struggling over the last 4 to 6 weeks. And you're seeing a lot of energy stocks breaking down through their 200-day moving averages. The XLE opened below the 200-day for the first time since last August, but closing back above it. I would keep a wary eye on charts like DVN and FANG and what else is in that group? CNQ and a bunch of these that have broken down through potential support, closing a little bit higher today, not really following through yet. Those are names to watch because I think the bear thesis for stocks would probably involve energy continue to rotate lower. Some of those late cycle leaders, breaking down and moving to the downside. You're certainly seeing that in industrials and materials. Chart number 2 for our 3 and 3 is Apple. If there's an encouraging chart in technology, there are not many. IBM maybe for a time has been a better chart. Apple is starting to be pretty interesting. What's interesting about the chart of Apple now is this 150 price level. I have a horizontal line just showing that 150 level. Look at how often this has been a meaningful level. It was resistance back here in the summer of 2021. The breakout in November of 21 finally sort of completed that upside follow through. We stalled out at 180 and came down to bounce off of 150 there in February into March. From there, we've broken down and retested it from below. And now again, we're right at that same level. We've regained the 50-day moving average. That's encouraging. Can we make a new swing high? A stock like Apple gets above 150. The RSI gets above 60. We make a new relative high. This is a nice improvement, particularly on a relative basis in a mega cap name. So how low could the major benchmarks go if Apple is hanging in like it would be with a break above 150? Finally, a ratio, hotels versus utilities. And one of my guests shared this. I forget who it is. I'm going to look back and try to do it, and I will definitely give them the credit when I can find it. Underperforming, that's a great offense versus defense ratio moving to the downside. Folks, that's a wrap for the show. And a special thank you to Carolyn Boroden joining us from Synchronicity Market Timing in Las Vegas. All of our previous episodes at StockChartsTV.com. For Stock Charts in Redmond, Washington, I'm Dave Keller. Have a great night. We'll see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.